Well, where did all the money go? Out of gold and out of hedge funds and into U.S. equities? That's part of the answer. Let's get more from Charles Biderman. He's the CEO of TrimTabs. He joins us now to talk about it and track all the money. So let's talk about the end of 2011. Give me a sense of the flow of funds over the month of December. So leading into the new year, what have you seen overall in terms of what investors are doing with their money?
In December, at the start of the year, there were outflows from equity funds. We've seen a trend the last week or so of some decent amount of money going into U.S. equity mutual funds, but that's a year-end phenomenon, in my opinion, not so much anything other than people are putting their money to work as they usually do at the end of the year. Money's been going into bank savings accounts and into bond funds and emerging market. Money's been coming out of gold and coming out of European stocks.
From what you're seeing in terms of money flowing out of gold, is that going to continue to be the trend in 2012, or do you see a reversal here from any of what the data shows?
Well, in my personal opinion, given that the world is full of governments printing paper and selling and trying to tell people this is really money, that gold probably was overbought. It's being sold off here, probably continue to be sold off through year end as hedge funds and whatever want to lighten their appearance of having a lot of gold on their balance sheet, so they're selling gold. And I firmly expect there to be a big bounce sometime starting in January 2012. I plan to buy some gold.
What do you discern from the data that you're seeing here at the end of 2011 about what we'll see in 2012? Are there indicators here?
Well, the key indicator to me is what's going to happen in Europe. Is the European recession going to deepen? I mean, things are in a downturn in Europe and getting worse. What will happen? Will it get worse? If it gets worse, it's likely that emerging market growth will also slow. In the U.S., 20% of our economy historically was due to real estate, and that's obviously not going to improve anytime soon. We are seeing a little pickup in automobile activity, as you usually would at this time in an economic cycle, but given that real estate is being sat on by the U.S. government and ridiculous policies are, depressing that market and will continue to have that market depressed, and given that state and local governments are being forced to let people go and cut their spending, it's hard to see how the U.S. economy is going to make any headwind. If there's no growth in the U.S. economy, there's not going to be any growth in new money to put into the market or into equities. So as of right now, the only source of new money going into stocks is coming from companies. Since QE2 ended in June, companies have been the net buyer of stocks, about $1.5 billion to $2 billion a day. Now, recently, that rate of buying has slowed. So if individuals don't come back in, if hedge funds, pension funds are taking money out or not putting money in significantly, companies have been the only buyer, and if they stop buying, it could get nasty.